Hi, Clint Coons here with Anderson Business Advisors, and in this video I'm going to discuss the difference between using a corporation versus a limited liability company for real estate investing. All right, so this comes up a lot. Should you create a corp or an LLC? Most of you, if you're watching this video, are probably thinking you need a limited liability company, and I see it all the time when I run into new investors. I ask them, what type of entity do you create? Oh, I create an LLC. Why? Well, everybody's doing it. Why wouldn't you? I was told from my local practitioner I need an LLC for asset protection, or I went to a RIA meeting and I was told I need to create a limited liability company. Okay, LLCs are great, don't get me wrong. We use them exclusively for holding assets such as rental real estate or flipping property. But it doesn't necessarily mean they're always the best entity of choice for real estate investing, because at the end of the day, you really have to understand what is it that you're trying to accomplish. If you're setting up an LLC, it's more than just setting up the LLC. How's it going to be set up? Is it member managed versus manager managed? Do you want anonymity, or is anonymity not important to you? Have you made an investment in getting real estate education? Would you like to make sure that you can write off that entire investment? That's important. What state do we set it up in? So these are many of the questions that come up over and over again when I'm teaching my asset protection workshop. People will be in there and I'll ask them, I'll say, did anybody here create an LLC? And a bunch of hands will go up and I'll say, all right, what type of LLC did you set up? People just stare at you. And I go, well, it's an LLC. Not realizing there are different forms of limited liability companies that have different purposes. So, should you use a corporation or limited liability company for your real estate investing? Well, what I'm going to determine when we're setting up this structure, what we want to look at for your investing is what type of investing are we engaging in. So if you're going to engage in buy and hold investing, then obviously, yes, we're going to use an LLC for our buy and hold investing. Now, the reason we're using the LLC is because what we want is flow through tax treatment. That's what you can get with a limited liability company, because you can elect to have it treated as a disregarded entity, a partnership, or an S corporation. That's flow through treatment. Now, for many individuals, what we're going to elect with these LLCs is we're going to choose either partnership if there's more than one owner, or we're going to choose disregarded if there's just one owner in the LLC. And not necessarily S corporation tax status. And I'm not going to go into that right now because it's beyond this video. But the point is, for buy and hold, we'll definitely do an LLC. That makes sense for those individuals. Now, if you're going to invest in tax liens or deeds, same thing. You can do that through an LLC as well. So tax liens and deeds. Indeed, we can use a limited liability company. And again, we're going to be looking typically for flow-through treatment, flow-through tax status on that LLC. Now we're setting them up. You may want to either set them up as member managed or manager managed, depending on if you want anonymity. And again, that's a different video. So how about if you're flipping? Okay, flipping property. So buy and rehab. Well, in this case, we're going to oftentimes do an LLC or a corporation. All right. Now, here's what's key to understand here. Should you use an LLC or a corp? Well, flipping, what I'm concerned about is the tax status. I don't want you to be tagged as a dealer in real estate. So to avoid dealer status, we need to set this up as either an S corp or a C corp to avoid dealer status. Because if you get tagged as a dealer, because if you wholesale property or flip property, then there are a number of negative tax ramifications that come from that. And if you just set up an LLC that's a flow-through partnership or disregarded, you're a sole proprietor, it's going to blow you up at the end of the year. So we want to minimize that. So we can do an LLC tax as a C or an S corp, and that would work fine, or we can do a corporation tax as a C or an S corp. So which one am I going to choose? Well, the question I'm going to ask you is, did you incur a bunch of expenses to get to where you are today? I work with a lot of people that come to our workshops that have been through various real estate trainings where they maybe dropped down $10,000, $20,000, $30,000. And I know you want to be able to write that off. So if you want to be able to ensure that you've covered every way in which you can deduct that expense, then you're going to want to go with a traditional corporation. And the reason why you're going to want to do that is for what's referred to as 1244 stock loss treatment. Stock loss, because that is only available to a corp, S or C. And what it means is this, that should you find that real estate investing isn't working out for you, or things happen in your life and you have to quit, any monies that you invested into this company, and namely the investment you made to learn how to invest in real estate, is something I would attribute to that company. You can then deduct that on your 1040 in the year in which you shut down your company if you made this election. And you have to make it at the beginning. You cannot make this election later on. It has to be made when you formed your company. So 1244 stock loss treatment is only available to corporations, and it gives you an additional out. If you're making money in real estate, you can write it off the expense through the company itself on an LLC tax as an S or C Corp, or a traditional corporation with that election. But if you decide that, hey, real estate investing is not for me, and you still want to capture those expenses, then I would go with the corporation and not the LLC for my flipping activity. Because with the LLC, when you shut it down, any of the investments you've made in there that you've not recouped, then you can write those off. But if you don't have the right type of income, you're going to carry it forwards, and you're only going to be deducting $3,000 a year. I ran into someone who had $50,000 when he called us up. And luckily, we'd created a corporation for them, and their CPA didn't understand this 1244 stock loss. And so the guy that called us up and said, listen, he's writing off $3,000 a year. I'll be dead before I capture all of this. I said, no problem. We'll just amend your return. We'll pick up the 1244, which should have been done because we set it up for you at the outset with that in mind. So when it comes to investing in real estate, corporations versus LLCs, what we're really focusing on is the structure, depending on if you have investments into that company you want to be able to recoup at a later date at high expenses to get it started. We're also looking at tax status. Okay, so what's really important here is you make the proper tax election for the LLC that corresponds to the type of activity that you're engaging in. So we've got tax liens and deeds, buy and holds. I said flipping. I'd also do wholesaling down here under the corporation tax status, again, because it's an active business. If you're investing in syndications, I would put syndications. Typically, they're going to be in a limited liability company because that's flow through tax status. That's the treatment we want. We want any gains or losses flowing down onto our 1040 Schedule E. So we'll drop that into there. You can take it from here. I mean, if you're doing apartments, if you're going to engage in self-storage, all of those things that you intend to hold more than a year for long terms, then we're definitely looking at the limited liability company. But when it comes to an active business, we're going to be out there doing things on an active basis, then we're going to go more towards the corporation. Now, this is just high overview stuff, because another layer that we're not going to be getting into is that if you have partners in your business, if you have partners that you're bringing into your active flipping business or managing syndications, promoting business, then we have to look a little deeper and then make a determination as what we need to ensure that there aren't any violated expectations, that everybody's interest is protected. And so then we may flop back over to the LLC realm. What do I mean by all this? At the end of the day, it's not a one-size-fits-all approach. What you really need to do is have a strategy session. At the end of this video, you'll find there's a link. You click on that, you can set up a free strategy session with one of our advisors that will analyze this for you and give you a roadmap. And there's no charge for it. And you'll figure out what is the proper structure for what it is you're doing. And more importantly, they're going to tell you where you should set it up, because I know that's a question that comes up a lot. Should it be Nevada, Wyoming, Delaware? Should it be in my own home state where I live? So with that, thank you for watching this video. Look forward to seeing you at one of my upcoming tax and asset protection workshops.